Hey guys, welcome back to the channel. So, we've been talking about taxes, and of course, we always talk about retirement and investing. But a lot of people are curious about, paying taxes during retirement and stuff like that, right? Because, you may not know how much you have saved for retirement, say in your IRA or a 401k plan, and whether you'll get money from Social Security or a pension. But do you know how much money that's going to be taxed? Do you know your filing status, the sources of your retirement income, the total amount of income you'll receive each year is going to determine your taxes in retirement. And then your taxes will affect how much money you really have to live on. So it's important to understand how your retirement income is going to be taxed. If you're not yet retired and you're still working, having this knowledge ahead of time will help you figure out how much you'll have, after taxes, right? If your after tax income seems inadequate, you can estimate how much more you will need to save before you can retire. If you're already retired, this is going to tell you whether you need to do some additional planning to avoid running out of money. And then understanding how taxes will affect your retirement income, that's going to help you consider ways to minimize your tax bill and maximize your retirement income. So, first thing we need to talk about is how is Social Security taxed, right? When you're retired. So, if Social Security is your only source of income, you probably will not owe taxes on it. Your income will be too low to be taxable. However, if you have other sources of income, right, including otherwise tax exempt interest income, a portion of your Social Security benefits might be taxable. More than half of Social Security beneficiaries pay some tax on their benefits. The percentage of families who receive Social Security benefits have to pay income taxes on them. I think it was less than 10% in, I'll make sure I get my year right, 1983, 84, but more than 50% by 2015, right? And it's probably going to rise to, between a lot of, 55 to 60% between 2015 and 2050, you know? And the amount of your taxable Social Security benefits depends on your combined income, right? I.e., the sum of one, 50% of all of your Social Security benefits for the year, two, the adjusted gross income, right, your AGI, and then three, your tax exempt interest income, right, such as interest received on municipal bonds. Your AGI is your gross, right, or your total income minus adjustments to that income, such as deductions and exclusions, right? Common sources of gross income include wages, salaries, tips, interest, dividends, distributions from your IRA or 401k, pensions, annuities, stuff like that, right? So, common adjustments to gross income include, say, like HSA contributions, right? Health savings account, which we've talked about, deductions for IRA contributions, student loan interest deductions, and contributions to self employed retirement plans, right? The level of your combined income determines the portion of your Social Security benefits that's going to end up being taxable. Well, how much income can a retiree receive without paying taxes? Okay. Well, this depends on the sources, right? And the total of your income. These income sources may include retirement account distributions from 401ks, IRAs, Social Security benefits, pension payments, and annuity income. Some people may also continue to earn some income from work as an employee or, through self employment, even though they may have retired from their regular long term employment, right? First, let's talk about earned income. Well, workers nearing retirement often ask how much income can a retiree receive without paying their, taxes, right? So again, it's going to depend on your income sources and total income amount. The IRS differentiates between income types and it classifies it as earned and unearned. So earnings from employment and self-employment are subject to Social Security, Medicare, and income taxes. Unearned income, for example, income from pensions, IRAs, annuities, and other investments, is subject to income tax under rules that may, they vary by the income source, right? So, if you're receiving Social Security benefits and continue to work and earn income, you'll have to pay Social Security and Medicare taxes on that earned income. However, if the total of your earned income, any unearned income, and Social Security benefits is low enough, you will not owe federal income tax on it, right? If your AGI is equal to or less than the standard deduction for your filing status, your federal income tax liability is likely zero, right? So, income from IRAs, pensions, 401ks, and other plans, right? Because some types of income are unearned, but that doesn't mean they aren't subject to income tax. Income from different sources may be subject to different tax rules, right? Ultimately, a retiree's tax liability depends on the tax bracket applicable to his or her total taxable income. So, if you claim tax deductions for your contributions to a traditional IRA, right, the distributions from that IRA may be taxable, depending on the total of all your income. So, similarly, distributions from a 401k plan or other qualified retirement account funded with before tax contributions are taxable. If your employer funded your pension plan, your pension income is taxable. Both your income from these retirement plans and your earned income is taxed as ordinary income at rates of 10 to 37%. Some individuals make after tax contributions, right? Which are contributions for which they don't claim tax deductions on to their IRAs. Occasionally, other types of retirement plans also are funded with after tax contributions. The contributions from such plans are not taxed to the extent that the distributions represent the return of previously taxed contributions. The information return Form 1099-R sent to a taxpayer who made after tax contributions to plans will report both the gross amount distributed as well as the taxable amount. IRAs, 401ks, and similar plans are required to make annual required minimal distributions, right, to those beneficiaries, right, beginning the year that they turn 72, right? So that required minimum distribution it was suspended for the 2020 tax year in response to the pandemic, right? But it's reinstated for 2021. Roth IRA and Roth 401k distributions are not taxable. Roth plans, which are funded with after tax dollars, do not have that required minimum distribution, right? Income such as dividends, rents, and taxable interest from investments held outside of IRAs, 401ks, and similar plans is subject to tax at ordinary income rates up to 37%. Capital gains rates apply to to the gains realized on the sales of investments, right? Long-term capital gains are taxed at low rates, ranging from a zero rate bracket to a rate of 20% for taxpayers with very high taxable incomes. So, because older people often have several types of taxable income, both earned and unearned, their tax rate and liability depend on the tax bracket that corresponds to their total taxable income, right? You determine your tax bracket in retirement the same way you did while you were working. Add up, your sources of taxable income, subtract your standard or itemized deductions, apply your tax credits that you're eligible for, and then check the tax tables in the, on the form 1040, right? More likely, put all this information, into a tax software program or give it to an accountant would be the easy way, right? So we just talked about deductions, right? Well, let's go into that a little bit, like standard deductions, right? So the standard deductions for 2021 are used on tax returns filed in 2022, right? The standard deduction for 2021 is $12,550 for single taxpayers and married taxpayers filing separately, but $25,100 for married taxpayers filed jointly and $18,800 for head of household. In the tax year 2022, the standard deduction for married couples filing jointly rises to $25,900, right? Up $800 from the prior year. For single taxpayers and married individuals filing separately, the standard deduction rises to $12,950, right? And then for head of household, the standard deduction is going to be $19,400, right? So, taxpayers who are 65 years of age or older, whether or not they are retired, are eligible for an extra standard deduction of $1,700. If they are single or heads of household and not married or a surviving spouse, and an extra $1,350 for 2021 per senior spouse if they are married filed jointly, married filed separately, or a qualified widower. If your taxable total income is less than these amounts, you won't owe any taxes. You usually won't even have to file a tax return unless you are married filing separately, though you may want to anyways. Filing a return allows you to claim any credits for which you might be eligible, such as the tax credit for the elderly and disabled or the earned income credit. So filing a return also ensures that you receive any refund that you might be owed, right? But we don't really want to overpay. Taxpayers who itemize deductions may not claim the standard deduction and bonus amounts. But it should be noted that the recent increases in the standard deduction amounts mean that the threshold at which older taxpayers benefit more from itemizing than taking the standard deduction is higher. These higher standard deduction levels might affect your decisions about when to make charitable donations or pay other deductible expenses. You may be able to benefit from itemizing in some years if you can lump large itemizable expenses together so that they fall within a single tax year. So for 2020, a special benefit for certain charitable contributions is available to non-itemizers. Taxpayers who claim the standard deduction on their tax returns can deduct up to $300 of charitable contributions made in cash above the line, right? That is, in calculating their AGI. Certain types of contributions are not eligible for the $300 deduction, though. So these are going to include one, gifts of non-cash property, right, such as gifts of security. Two, contributions of private non-operating foundations. Three, donations to supporting organizations and new or existing donor-advised funds. Four, contributions to veterans organizations, fraternal societies, and certain cemetery and burial companies. And then five, contribution carry forwards from earlier years, right? So one of the last things to talk about is going to be these tax brackets we keep mentioning, right? So let's talk about the tax brackets. These are the taxable income brackets for 2021, your ordinary income tax rates, right? So you can see for married, joint, and then, single, right? You can see 10%, 12%, it goes all the way up to, 37%. So basically, and it's a marginal tax rate. So you pay 10% on all your money you make, right? If you're single, up to $9,950, you only pay 10% on that. And then anything over that, you pay 12%. Anything over 40,000, 525, you pay 22% on that, and so on and so forth, up until however much you make, right? Well, let's talk about the bottom line then. So are you going to pay taxes in retirement? Well, unless your taxable income falls at or below the standard deduction level every year, you're probably going to. How much you'll pay, though, now that's another story. There are many ways to help retirees minimize their tax burden. Strategies include timing distributions, bunching income, bunching deductions that can be itemized, and doing retirement account conversions. There's so many different ways for you to, figure out how much money you're going to be making and how much is going to be taxed. There's just a lot of information. And if you feel like it's overwhelming, I would recommend, go and find someone that can help you do it. Get an accountant or a CPA or, whoever you feel comfortable with. And I hope this kind of helped you guys get like your bearings on it. I know it's a lot of information. Hopefully I didn't overwhelm anybody. But if you enjoyed this video, I really appreciate you subscribing to the channel if you're not already. Go ahead and give this video a thumbs up. So I'll see you guys in the next video. Y'all be safe.